Good morning. Welcome back to the Broadcast Retirement Network. This is BRN Weekly for Saturday, May 11th, 2024. At our top story today, the stock market rally continues. Joining me now to discuss this and a lot more, Kristina Hooper is the Chief Global Market Strategist for Invesco. Kristina, always great to see you. Thanks so much for popping by the program this morning.
Jeff, it's so great to be with you. Thanks so much for having me.
And I want to start with a basic question here, Kristina. Over the last couple of weeks, we've gotten some interesting job data, including jobless claims, but also some interesting economic data. Yet it appears over the last 7+ days, the stock market rally has continued. I want to pull back and ask you, what do you make of all this data that we're receiving and the result in the market?
Well, as has been the case for years now, monetary policy is a key driver of markets. And right now, it's actually, I think, the key driver. And I shouldn't say monetary policy so much as expectations about monetary policy. And so if we go back to last week, the week did not start off well. There was real trepidation about the Fed meeting and what the Fed might say. And then we got a rather dovish Fed, a Fed that acknowledged that while disinflationary progress had stalled in the first quarter, that there had been very significant progress over the past year, and that a rate hike was very unlikely. Fears had grown that the next move for the Fed was going to be a rate hike. And so I think many walked away saying, wow, this Fed is looking a lot better than I expected. It's far more open. It just needs a little more data, a little more confidence before it starts cutting. And then on cue, we started getting data that I think is helping make the Fed more confident. And of course, the key data point was Friday's jobs report. Much lower job growth than expected and lower average hourly earnings, which is something very, very important to the Fed because it relates so much to inflation. So all in all, that was a very good week. And that is why we've seen a really strong rally over the last 7 or so days. We've gotten continued relatively weak data. We saw higher than expected initial jobless claims the other day. All of that is telling us that the economy is cooling and inflation is likely cooling. And so we may very well get the data over the next couple of months that makes the Fed comfortable enough, I will predict, to cut as early as July.
Wow. Okay. So, and very succinct and to the point. Even I could understand, Kristina, which is great. I want to ask you. Let's talk a little bit about the Fed. And you talked about getting this data. So you mentioned July, but certainly, and I have to pull back and say, I'm just always impressed with the fact that how markets, everything is about rate cuts. Everything is about what the Federal Reserve may or may not do, at least from the outside looking in. So the expectation is we're going to at least have one rate cut here is what you seem to think, at least one rate cut. And that's what the markets are kind of building in.
Well, markets, it's interesting. There's been an enormous amount of fluctuation in terms of what the market expects just over the last few months. I think we started the year with expectations of far more rate cuts. That went down to 1. I think it's back up to 2 now. I suspect that the sweet spot where we're going to end up this year is 2 to 3 rate cuts. Of course, this is all very much data dependent. But what I'm seeing suggests that we're going to get enough data that the Fed feels comfortable. It has admitted that it is in very restrictive territory right now, that it doesn't need to see a weakening of the economy. It just needs to see more disinflation. And so that, to me, sets us up for 2 to 3 rate cuts this year.
And when you look globally, specifically the Eurozone and other central banks, what's the outlook like there? Because a lot of times, the U.S. central bank drives or has driven in the past a lot of the reactions of these other central banks. What about Europe? What about some of the other parts of the globe?
That you make an interesting point that the Fed really has driven other central banks. What's interesting is that this time around, what we saw already were a few central banks making rate cuts thus far. So we got Swiss National Bank, I believe in March. We got Riksbank the other day. So this suggests to me that the issues are very much local. There's a divergence in data, and there's just been more disinflationary progress in places like the Eurozone. So I think it's a fait accompli that we get a rate cut from the ECB in June. It's not waiting for the Fed, but I think the Bank of England is likely to follow in lockstep with the ECB. It's not waiting for the Fed either, but it does seem to be waiting for the ECB. So I think when we look back at the end of this year, what we'll see is pretty significant lockstep movement between the Fed, the ECB, the BOE in terms of starting rate cuts around the same time. But different conditions. I mean, certainly they share some very significant commonalities. We all shut off our economy like a light switch. We all threw fiscal stimulus at it, but the U.S. threw more fiscal stimulus. And there are, a few different, what I would call sort of differentiating key factors that have caused some divergences. So we'll see, I think, the ECB move, the BOE, and then the Fed. But we're all heading towards the same place. We're all with a bias to easing, and I think we will see some easing. It will be rather gradual this year and will probably accelerate next year.
Last question, Kristina. I want to ask you about some of the global tensions, not the politics of it, but things that could happen as a result of what's going on in the Ukraine, in the Middle East. Oil prices, I think, have kind of really fluctuated, especially with what's happening in the Middle East. How concerned should or are central bankers, and are they aware? I know they're aware, but I mean, how do they process these global events into their own factoring of interest rate cuts or interest rate increases?
Well, I think that all central bankers have to be concerned about things like a rise in oil prices because it can impact inflation. Now, typically it impacts headline inflation, and then if it's persistent enough, it will seep into core inflation. So it tends to be a concern that's a little ways off. We've certainly seen some spikes in oil prices, but the reality is that Western developed countries are in a very different place than they were in the 1970s. In fact, in 2023, the United States became the biggest producer of oil by a wider margin than it has been in the past. And so this is a situation where there's a significant amount of energy independence that is, in my opinion, helping to keep down the price of oil. We also have other factors. We have concerns about demand in other parts of the world. Perhaps there's a slowdown that impacts oil prices. A lack of ability to control production among OPEC plus countries. All of those are considerations. And I think the picture today is a fairly benign one when it comes to oil prices. Now, that could change. We'll have to watch that closely. But certainly, this is not like the 1970s. I would argue that actually today, semiconductors are the most important component in the global economy as opposed to oil. I mean, oil is still very important, but we've also gained a lot of energy independence between the 1970s and today. So, from my perspective, I don't see it as significant a concern, but we certainly want to follow this closely. I think of growing tariffs and the kind of friction that we're seeing right now could potentially be a bigger problem. But again, to me, the risks are not dramatic today. We'll just have to follow the situation closely.
Yeah. Well, Kristina, excellent analysis as always. Great to see you. Thanks so much for joining us. And we look forward to having you back again on the program very soon.
Thanks so much, Jeff, for having me.
And when we come back, we'll take a look at some of our best segments for the week. You're going to want to stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network. Well, good morning. It was another week of great shows with great topics and, of course, great guests. We kicked off the week with a look at the evolution of participant engagement. Let's take a look.
Yeah, and I think it comes down to data. There's just so much more data that's available now that can be used to measure that engagement. And one of the things that we really focus on is that participant journey. So how do we keep participants clicking? How do we keep them learning? How do we keep them engaged on the site? And one of those ways is through gamification. And our solution allows for an overall financial wellness quiz, as well as the ability to earn points and the ability to challenge someone when they're viewing content to answer a question. And when we measure the effect of that gamification, we see that all of the metrics that we look at around participant engagement more than double when gamification is included. So we see they spend more time overall in the financial wellness solution. They spend more time on content. They're returning more frequently to the site. So that's all great and measurable. And then taking that even another level, when the client offers incentives, we see metrics go sky high. We'll see that where normally for gamification, we may see 10% of participants answering a quiz. When an incentive is offered, those numbers can go over 80% of participants taking those quizzes. And the incentive doesn't even need to be that meaningful. It might be a small gift card, or it might just tie into an overall program. But those are all just very measurable ways to see how we're driving engagement.
Yeah, so we've kind of all heard that financial wellness is not one size fits all. That's really not a new groundbreaking idea. But, at SS&C, we really have to start with the goal in mind. And that really is to create content that resonates with individuals and motivates them to learn. That's what we want. That's what our clients want. But like you said, yeah, today in a digital landscape, that's extremely challenging. We have fleeting attention spans. The competition right now is fierce. And let's be honest, when it comes to financial wellness, it's really not really high on participants' to-do lists either. So how do we combat that, right? So we provide relevant content to drive engagement because it demonstrates an understanding of the audience interests, needs, and pain points, right? So when content resonates with users addressing their specific challenges or interests, it's going to capture their attention and foster kind of that sense of connection. And couple that with what Alicia said about gamification. You're now building and attracting users to come back for more, which then increases the loyalty to the site, increases their education over time, which is, in turn our goal. So, we tailor content to match the preferences and concerns of the audience. So if someone is 20 years old and just coming out of college, we're making sure that we've got content that resonates with them. If someone is 60 and looking to retirement and have really no idea where to start, we've got content that's relevant to them. We also stay on top of what's going on in the industry right now. So we're making sure that we've got content on Secure Act 2.0, for example, always changing and making sure ultimately that we're contributing to the success of higher education.
Yeah, and it's something that certainly has continued to evolve. And now we're seeing a lot greater ability to take large data sets, normalize it, and really individualize the experience. So the ways that we think about that is we have multiple engines that leverage ways to personalize to the individual. The most impactful is from an outcomes perspective is our call to action engine. So what we're doing there is we're looking at the profile data about the participant. We're also looking at their behavior on the site as well as what they're looking at right then to say what call to action is going to be most meaningful to drive them to improve on their outcomes. And we see a lot of success with those. So when those calls to action reside on specific content pages and they're directly relevant to the topic that the individual is looking at, we're seeing click-through rates of 30 to 50%. We can look at different metrics on where those are placed and see where we get more success. We can vary the creative. And again, those are a way for us to say, we know that small behavior changes can have a big impact over time. So these calls to action are a way for us to say, take that next step to based on what you've learned to really improve on where you are now.
Next up, we discussed how high school students feel the bite of financial pressures. Let's take a look.
So first, let me just give you a teeny bit of background about the RMJ Foundation. We are the state credit union foundation for California and Nevada. And that means, we're a 501c3 charitable organization supported by credit unions in our two states. And our mission is providing resources to credit unions so they can deliver financial education in their communities. So with that, the Bite of Reality is our signature program. And it is a reality fair. We didn't create the concept of a reality fair, but we like to think ours is pretty unique in how it's done. Rather than, it's an in-person fair, so kids get assigned an identity. They're told, you have this job, this is your salary. Your spouse has this job, this is their salary. You have a child, you have some credit card debt. You may or may not have student loan debt. And so this is your monthly budget, basically. Now go spend your money. We don't give them a lot of instruction. And they're physically in a room, typically like a high school gym, but in, a variety of different places. And there are 8 tables set up where they go to one table to buy transportation, one for housing, one for groceries and dining, one for kid care, all the things that we all have in our monthly budgets. There's a table for that. And what we don't tell the kids, but we tell the volunteers is, because they're playing the role of a merchant. So we tell those volunteers, you're on commission. Like, it's all about the sell. We want to get the kids to buy the most expensive thing at every station, because we want them to run out of money. You learn when you fail. And we want their hopeful first failure with money to be in our safe place.
Yeah.
Now, when they do run out of money, they get to go to the credit union table. And that's where they get some financial counseling, figure out where they overspent. And we actually let them return any item and buy a more affordable item. High school age is the target. We go as low as 8th grade. Younger than that can do our program. They can follow the rules, make the purchases, do all the things. But we don't feel like it has the same impact because real life isn't on the horizon yet. Yeah. So I don't think it's as impactful. We also very successfully do the program at college level, and some and our credit unions can deliver the program to whatever communities they feel like need it and they want to be in. So for some special circumstance adult situations, the program is used as well. Let's just talk about the high school kids, because that's, again, the bulk of the participants in our program. It's real. It feels like it's relevant to them. And so our program, it's an hour and a half. They're not learning everything they need to know. What they are doing is getting some awareness about you don't know what you don't know. Mm. So it's a real eye-opener. And it's a great launch into, we're going to come in next month and do an hour on credit cards or credit and credit scores and debt and checking accounts. And, now that the students have had that awareness, they're much more likely to recognize the importance of paying attention to the maybe not as fun and interesting, but still very relevant education.
Well, certainly great shows this week. I want to thank all of our great contributors. And that wraps up this episode of BRN Weekly. Have a topic of interest, someone you think we should talk to? Then drop us a line. And don't forget, for all the latest curated news and lifestyle, wellness, finance, tech, so much more, and all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content? Then visit our website. We're back again tomorrow for another edition of BRN Sunday. We'll be joined by the Legal Eagles, David Levine and Kevin Walsh of Groom Law Group to help break down, what's going on Capitol Hill when it comes to retirement and benefits. And then Oliver Rennick of the Schwab Network will be here to help make sense of these financial markets and the economy. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the First Lifestyle and Wellness Network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.